Hey everyone, welcome back to Corporate Dakota, the place where we break down the big money stories. And today it is time to look at Southern Missouri BANCORP, Incorporated's latest report. And let me tell you, it is packed with enough banking numbers to make your head spin. But don't worry, make it all make sense. And before we dive deeper, if you appreciate getting straight, unvarnished insights from corporate filings like this, do us a favor and hit that subscribe button. It really helps us out. And if you want to connect with other finance enthusiasts, you can join our Discord community linked in the description below. Alright, so Southern Missouri BANCORP Incorporated, also known as SMBC, is giving us the quarterly report for the period ending December 2025. Think of this as a Dr. S checkup for the bank, really showing us how they are doing financially right in the middle of the year. Let us start with the big picture, a snapshot of what the company owns and owes. At the end of December 2025, they had total assets of over $5 billion. That is a lot of money, and it's slightly increased from June 2025. Now, where does all that money sit? Well, their cash and cash equivalents were about $134 million. Interestingly, this is down from over $192 million in June 2025. This might mean they are lending out more money or investing it, which is generally a good sign for a bank. Speaking of lending their loans receivable, the money lent out to customers after accounting for potential losses was over $4.1 billion. This is a solid increase from June 2025, suggesting they are actively growing their loan business. The allowance for credit losses, or ACL, which is basically a reserve for loans that might not get paid back also, sits at over $54 million. This is a crucial number to watch. Now, how do they fund all this lending? Their deposits are the main source, which stood at over $4.3 billion. This is a slight increase from June, showing their customers are sticking with them. And what about the owners? Their stockholders' equity was about $567 million. This also saw a nice jump from June thanks to retained earnings, which are profits the company keeps. Moving on to how much money they actually made. For the 3 months ending December 2025, their net income was about $18 million. This is a good jump from the previous year, showing improved profitability. A major part of a bank's income comes from the difference between what they earn on loans and what they pay on deposits, that is called net interest income. For the 3-month period, this was over $42 million, an increase of about 12% from the prior year. This suggests they are effectively managing their interest rate spread. However, they did set aside more money for potential credit losses, which was over $1.6 million. This is higher than last year, which might be a sign of increased caution or an acknowledgement of a tougher economic climate. Their income from sources other than interest like fees was around $6.7 million. This showed a slight dip compared to last year. On the expense side, non-interest expenses were about $25 million. This also saw a small increase. Putting it all together, their net income for the quarter was $18.1 million, which is a healthy rise from last year. Then we have comprehensive income, which includes things like unrealized gains or losses on investments. For the quarter, their comprehensive income was about $17.8 million. This was slightly lower than net income due to some unrealized losses on their investment securities. Here we see the story of equity over time. It increased primarily due to net income, but was reduced by dividends paid to shareholders and treasury stock purchases. Treasury stock is essentially company stock bought back from the market. Now let us track the actual cash. For the 6 months ending December 2025, they generated over $37 million from operating activities. Remember, this is cash from their core business like lending and deposits. Their investing activities used over $112 million. A big chunk of this was the net increase in loans, which means they issued more loans than they received back in principal. In financing activities, they saw an inflow of over $15 million, primarily from an increase in demand deposits and savings accounts. Let us talk about asset quality. This table shows how many loans are past due. At December 2025, about 0.71% of their loans were past due by more than 90 days. This is up from 0.57% in June and 0.21% last year. While still relatively low, this trend is something to monitor closely. Looking at non-accrual loans, the ones on which interest is no longer being recognized as earned. These also saw an increased non-accrual loans stood at almost $30 million at December 2025. This increase is mainly driven by commercial real estate and agricultural loans. The allowance for credit losses on loans is a big number, and it went up to over $54 million. This increase reflects management's assessment of the economic environment, loan growth, and some specific borrower issues. Banks are heavily regulated and capital requirements are key. The report states that SMBC and its bank are considered well capitalized. Their ratios all comfortably exceed the minimum requirements set by regulators. This is a good sign for stability and safety. Here is where it gets interesting. They did an interest rate sensitivity analysis. This basically estimates how much the company S net portfolio value, or NPV, would change if interest rates went up or down. As of December 2025, their NPV was projected to decrease by about 18% or $112 million if rates went up by 400 basis points or 4%. This indicates they are somewhat exposed to rising interest rates. On the flip side, a decrease in rates has a positive impact, which is good given the current interest rate environment. Let's focus on the results for the 3-month period. Their net income rose by 23.9% year over year, showcasing strong quarterly performance. Net interest income increased by 12.4%, showing good management of interest spreads. Non-interest income, however, saw a slight dip of 1.3%. This was mainly due to a refinement in how they recognize loan fees. Non-interest expenses increased by 1.6%, but this was relatively modest considering the slight increase in data processing and occupancy costs. Overall, a solid quarter. Looking at the first 6 months of the year, the picture is even stronger. Net income jumped by 24.7% from the previous year. Net interest income grew by a significant 14% thanks to increased asset balances and an improved net interest margin. Provision for credit losses did increase substantially, more than double from the prior year. This is a key takeaway, suggesting they are preparing for potential loan defaults, possibly due to softening economic conditions. Non-interest income decreased by 4.9%, which was mainly due to fewer loan sales and changes in fee recognition. Non-interest expenses actually decreased slightly by 0.8%. This is impressive, indicating good cost control. The allowance for credit losses is a big number, sitting at over $54 million. This is a critical area that management clearly is focused on. Some of this $7.0 million directly relates to non-accrual loans. The non-performing loans ratio stands at 0.71%, up from 0.46% last year. This increase is definitely something to keep an eye on. Liquidity is how a bank can readily access cash. The report indicates they are well positioned with strong deposit growth and access to FHLB advances and the Federal Reserve discount window. They have ample resources to meet commitments. Their regulatory capital ratios are robust, which means they are in a strong financial position to withstand economic shocks. Now let us talk about the story here. Southern Missouri Bancorp is showing growth in its core lending business, with net loans increasing significantly. Their net interest income is also strong, benefiting from a favorable interest rate spread management. However, the increase in provision for credit losses and non-performing loans suggests they are proactively bracing for a potentially tougher economic environment. This is wise given the current macroeconomic uncertainties. They seem to be balancing growth with prudent risk management. What is really interesting is their exposure to interest rate risk. While they have some protection through derivatives, a significant rise in rates could still impact their net portfolio value. The slight increase in past due and non-accrual loans is a yellow flag, but a small one so far. Their strong capital position is a key strength, providing a solid cushion. In conclusion, Southern Missouri Bancorp appears to be navigating current economic conditions with a mix of solid growth and cautious risk management. They are growing their loan book effectively and managing their interest rate spread well, but the uptick in credit loss provisions and non-performing loans warrants close observation. Their robust capital position is a major positive, ensuring a degree of safety. So what is your take on SMBC's financial health, and these numbers? Do you think their proactive approach to credit losses is timely, or are they being too conservative? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more deep dives into corporate finance. And remember to join our Discord community, linked in the description, for more great discussions. Thanks for watching, and we will see you in the next video.